Good morning and welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi, and I'm joining you live from Apollo Global Management Headquarters in the heart of New York City. Apollo is the parent company of Yahoo Finance, but it's also one of the largest private equity firms in the world and a major player in the retirement market. All day, I'll be taking you behind the scenes of this financial powerhouse, showing you how a top Wall Street firm like this makes investing decisions that ultimately impacts your wealth. That is for sure. All right, I'm kicking things off with a look into private credit. Private credit is a $40 trillion market. What happens in this market most certainly has implications for the broader stock market. Can't ignore this market. It's also perceived as risky, despite a good chunk of the market being investment grade. This especially top of mind recently when JP Morgan CEO Jamie Dimon said, when you see one cockroach, there's probably more after the Tricolor and First Brands bankruptcies. But according to our next guest, it's an area of the market that deserves more attention. I'm joined by John Cortese, Apollo's co-head of corporate credit. Good to see you right next to the coffee bar, beehive of activity.
This is where it's happening.
Thanks, this is where it's happening. Thanks for kicking us off here. So before we get into the private credit market, and maybe it probably dovetails, this is Federal Reserve Day, decision day in America. How does it impact what you do from day to day?
It's funny, I was looking at the range of estimates for Fed cuts over the next year, and is it going to be one cut or is it going to be two cuts? It's amazing how a year and a half ago, 2 years ago, this was where you wanted to really focus your attention, and even we were spending a lot of time on it. For us, the bigger debate is, and this is out there publicly, is U.S. investment grade issuance in the public market going to be 1.6 trillion or 2.2 trillion? How about the private IG issuance out there? These are huge differentiations of potential CapEx spending and credit lending potential for the next few years. And that's really where the big conversation is for us, and I think that's going to drive broader markets.
Not to preempt Fed Chair Jerome Powell, I'm going to assume we're going to get that rate cut. That's what they're going to do later on.
90%.
Right, so we get that. How does that change the outlook for private markets and private credit next year?
Well, take 2 years ago, 2023, Apple issued a long-dated investment grade bond below Fed funds rate, because the curve was inverted.
I remember that.
And 10s, 30s were so flat. So it was like 4.85% versus 5% Fed funds. Now these same very high quality issuers, maybe people think of them as quasi-sovereign issuers, are issuing at 150 to 200 basis points above Fed fund rates, because not only is the Treasury curve steepened, but also there's so much issuance out the curve. And for us, that's incredibly exciting. As long duration, high quality lenders in the marketplace, I think that sets a kind of floor for spreads out the curve. And that's really our sweet spot over the next few years.
Help us understand, a lot of folks come to Yahoo Finance, they know us for stocks, the Magnificent Seven, you name it. How does what you do right now in the private markets impact equity holders?
The largest issuers of equity in the world, the largest by market cap weightings in the world, generally have been underrepresented in the credit markets, certainly the public credit markets. Take the Mag 7 I think the highest one is Oracle in terms of how much of an issuer is in IG. Most of them are 100 to 200th largest issuers.
And Oracle's just getting started based on that backlog.
Just getting started. These companies over the next 2 or 3 years are going to be the biggest components of the investment grade market as well. Way faster change even than what we've seen in equities. It is driving everything. It's driving the economies, private and public. And so I think really paying attention to this dynamic, this is where it's at. IG is where it's at, and we're really happy to be at the center of it.
I heard Apollo CEO Mark Rowan at the Goldman conference this morning talking about the expansion of data centers, how these companies building data centers need more financing. What does that mean to private credit? That Mag 7, like we're talking about, all these companies building data centers, trying to support the future of AI. How does that change the complexion of private markets?
We are looking at very large shifts in terms of large financing needs across Europe and US. Data centers is one of them, defense spending, energy transition. And for us, that is a public and private story, but actually mostly a private credit lending story. It's long dated. These are very long dated cash flow needs. And for us, as a large, retirement services driven business with very long dated liabilities, it suits us really, really well. And so that's the really big takeaway for us, is we're really excited about the next few years as being a much more of a buyer's market for that kind of long dated spread that's going to be driving the European and US economies.
We're seeing a lot of these companies take out, this is significant debt. It's been a while since this country has seen this type of investment in these data centers, for example. How does that change? Is there concern rising in the market that there is too much debt being taken out?
Well, most of these companies have very little net debt relative to their EBITDA. They're just getting started. They've mostly been spending their cash flow on this. They're just starting to become asset heavier businesses, so they're entering the debt markets. A good example, Meta tripled the amount of IG debt outstanding in 1 month in September. The entire outstanding amount of debt tripled in a month. So you're just getting started in terms of issuance, and it'll last many years. We think in terms of how much spending has to happen for this CapEx cycle, just related to AI, let alone other needs that are happening in the economy.
What are people still getting wrong about private markets?
I think that there is still an association with sub-investment grade. So when people talk about private credit, they're mostly referring to the sub-investment grade market. Still a big market. We are involved in that market. I think it's grown a lot over the last few years, and so that's why it's top of mind. But really, it's grown also with the public markets pulling back. So public 2022 and 2023 issuance and high yield and leveraged loans was down a lot. It happened to grow in private. But for us, we've been spending time in private IG since the 10, 15 years ago, since we really started to get involved in the retirement services business. But that market also way predates us. The banks have been doing this for decades. So it's really the driver of the broader economy. It's very diversified. It's generally secured. It's long dated. It's really a very different asset class. So just thinking about private credit as a commodity is not the takeaway. You have to actually get into the weeds of what are you actually talking about. And for us, 38 of the 40 trillion is a private IG opportunity.
We, I mentioned at the top of the show, we saw Tricolor. We saw people concerned about what was happening with companies like that, just lower quality. How come that didn't spill over into the equity markets? We saw maybe a little pressure here and there, but we didn't get that spillover event that I think people were worried about.
Yeah, at this stage in the economic cycle, you are seeing credit defaults happening, but they're not outsized. Even if you look at projections for next year, most banks are calling for 2% defaults in high yield, maybe 3% at the upper end for leveraged loans. And if you look at the indices and the public indices, even though spreads are very tight, they're actually really, I would say, the breakup makes a lot of sense. 3% of the underlying indices trades at 1,000 basis points or higher, and the rest of the market trades really tight. High yield is mostly at a 150 to 250 spread, except for those 5% of issuers trading at 1,000 plus. So the market's really efficient in saying these are businesses and business models that we think have to restructure. It's pricing it already that way. And of course, you're going to look at individual names when they do restructure as saying there's maybe something more to it. But the reality is the broader economy is really strong. Torsten's going to be on today talking about it.
I can't wait to see Torsten.
He's,
I hope he comes armed with 15 charts for me.
I think he's going to have more, maybe more than 15.
Is investment grade right now still investment grade?
Sure, yeah. I mean, not only is it rated investment grade, so that's by the actual little definition, but you're talking about secured, low LTV, highly collateralized, first lien lending that's happening in very diversified formats. So it's a big market, but it's growing. Even at a 2 or 3% GDP growth, you're talking about a huge need for very safe lending, very low historical default rates, practically zero if you look at the history of Apollo and Athene. So it's still very much IG, and it's actually growing because of, again, those big needs for, think about the big needs are also backed by governments or investment grade companies. These are the highest quality issuers of debt in the long run for the next few years, so it's really exciting.
Let's say we do get, one more rate cut early next year after this one. How do you see that impacting markets more broadly next year?
I mean, the rate curve has been steepening. So I think you're seeing, yes, we have reasons there. Torsten's talking about the K economy, and many out there are doing that. So there are reasons to cut rates maybe near term because you're kind of seeing that differentiation. But long term, rates have been pretty sticky. And so I think a steeper curve is going to bring in more opportunity for, again, long dated financing. It might bring more leverage into the system. That's not our ball game. Our ball game is issuing long dated liabilities and investing in long term assets. So I think that for us, when an asset leaves the banking system and comes into our world, it becomes safer because we're not funding it with near-term deposits. But I think that's kind of something you want to pay attention to is where's the leverage in the system going.
And of course, you're not just making bets for next year. I mean, these are long-term bets that Apollo's making. How could one go about making money over the next decade from some of the trends you've talked about?
These are the biggest issuance opportunities in the world that we've seen in credit, certainly in my lifetime. And so I think, again, you're becoming from a seller's market to a buyer's market. That probably means spreads will be, eking wider. We've probably seen a floor of credit spreads, but it'll be combined with a lot of issuance. And so I think high quality. It doesn't get better than being able to buy a lot of good stuff at wider spreads, which is the opposite really of what the market's had to look at the last few years. We've succeeded in finding plenty of things to invest in. We're largely IG focused. but I think that the opportunity to invest at wider spread levels in good credits has just begun.
Lastly, John, has there been something that has surprised you in markets this year?
I think the entry of AI into credit, it's really the story of 2025 in credit is the year that AI entered credit. And I think it's going to be here for a while, and I think that's just a new thing to think about. It touches a lot of different asset classes that we participate in, and we're spending a lot of time thinking about it.
Do you see the companies that have issued a lot of debt this year to support, let's say, data centers or their compute power, whatever it is, you think we'll have more in terms of dollar value next year? Is this just the tip of the iceberg that what we've seen this year?
Tip of the iceberg.
Wow.
It's just beginning, and it's happening in a lot of different asset classes. So it's not a commodity. Like everything, it's not a commodity. Knowing your contracts, knowing your counterparties, having good underwriting. We have 4,000 plus originators doing this every day. We've got hundreds of investment team members that are going through all these asset classes. You need to have that to do this at scale, to have that breadth of origination, to ultimately invest in good portfolios. And it's going to be about who does that best over the next few years.
And we're gonna let you go. It feels like I'm keeping you from the coffee bar here.
Espresso.
Yeah, I know. I need another one too. John, good to see you. Thanks for kicking off our coverage today. Appreciate it. Thanks so much. All right, coming up, plenty more from Apollo Global Management, including how investors can put together their portfolios for success. That's next on Opening Bid. Carefully building your portfolio is crucial to growing your wealth over time, and the traditional 60-40 portfolio isn't the winning formula it once was. Here with more is Stephanie Drescher, Apollo Global Management Chief Client and Product Management, Portfolio Management and Trading. Good to see you, Stephanie, and I totally bungled her name. You know, look, this is live TV, this is what we're doing. Apollo Global Management Chief Client and Product Development Officer. Good to see you.
Good to see you, Brian. Thanks for having me.
Just had a fascinating chat with John Cortese on how interest rates are impacting private markets. Like, what's your vibe on that? How do you see it impacting what you do?
Yeah. So look, the client interaction is phenomenal. Kind of through their advisors and they see Apollo as a firm who has navigated market cycles, interest rate cycles over decades now. And importantly, when we think about interest rates and the interest rate environment, we do anticipate that interest rates will likely be higher for longer, which could create a headwind for the 60-40 portfolio. And we certainly saw that in 2022. And when we couple that with the concentration that exists now in the stock market, S&P 500, the ups and the downs really correlated, as we know, to kind of 7 companies at the end of the day. So the need for private market exposure as a piece of the fixed income portfolio and the equity portfolio is really critical to make sure that our clients and ultimately their portfolios benefit in many ways, which we can go into, that as the institutions have seen over decades now. So we do expect an environment where interest rates will likely be higher for longer, and that proves to be beneficial to the inclusion of private markets in an overall 60-40 portfolio.
Does that concentration risk in the S&P 500, does that worry you?
So, look, we've seen not only on the ups, but even on, in the first quarter of the year, how 95% of the decline in the S&P 500 was in fact based on those 7 companies. So the idea of replacing a percentage of an otherwise kind of public equity portfolio with more diversification, we believe provides that excess return per unit of risk. When we look actually at all companies globally, 90% are in fact private. Yet it's still kind of a very small percentage, certainly of individuals that have that exposure in their portfolios. So in our view, in order to create the diversification that the individuals and families deserve, you need kind of both levers, both the public and the private in a portfolio. And to your point, when you step back and look at the total size of public companies out there today, it's actually half of what it used to be. So I think times have changed, and it's a moment for our advisor community, the financial community, to recognize and question, are things in fact different today than they used to be?
Every day, or it seems like every day, Stephanie, I see a new tech company raising money at a valuation that frankly blows my mind. And then you drill down to the company, they're not making any money today, tomorrow, or probably the next year. What's your sense of the valuations we're seeing right now in private companies?
Look, our philosophy as a firm is purchase price matters. That's just who we are.
I've heard that so many years from Mark, and it's a good line.
You know what? We stick to it. So, over many cycles and decades now, as a firm, we've seen valuation cycles, and we maintain our discipline, because at the end of the day, that underwriting process, the consistency, the rigor, that's what our clients trust us to do. And we're aligned with them. So our own capital are in the strategies that we manage on behalf of our investors. And that's super important, because we can't guarantee the outcome, but we can guarantee a shared outcome. And they trust in that over cycles.
Is it hard to stay disciplined when you see this fear of missing out, or FOMO, and it's out there and it's alive in the markets?
So, you know what, when I think about the firm and our investment committee process, there's such a discipline that runs through how we source our assets on a highly proprietary basis, how we originate, how we review the diligence, and we just keep that focus. So frankly, we don't see that in our investment decision making. We want to make sure that our entry point and the price, ultimately, that we're creating a portfolio ultimately delivers the risk return that we believe is appropriate for the asset and for our clients.
Are the valuations we are seeing in private markets, are they frothy?
We find our way in terms of navigating the market, and we've deployed a very meaningful amount of capital. So, as a firm, we look to originate ultimately assets that we're comfortable with in terms of entry point and purchase price. And we tend to kind of not generalize in terms of the market, because we pick our spots.
If 60-40 is no longer the playbook, what is the ideal way for someone out there to build a portfolio?
So as we speak to advisors on behalf of their clients, it's giving them more tools in their toolkit as they think about what their client is trying to plan for. What do they need to save for retirement? What wealth do they want to build? And therefore, when we look at the overall portfolio, we can then determine what liquidity they need, or illiquidity they can accept. And there's a whole range now of structures that give more choice, ultimately, to the advisor and to the clients that they serve, in order to use both public and private solutions in the portfolio. And what we're seeing already is that private market building blocks are not only selected on an individual kind of strategy by strategy basis, but more frequently now, we're starting to speak to advisors about how a portfolio of private markets can complement what they have in the portfolio, or how private markets can be a key part of a model, or a more holistic discretionary pool of capital. So there's so many use cases, but at the end of the day, it's looking at the fixed income portion and the equity portion of a portfolio, not as simply public options, but looking at alternatives to those public stocks and bonds.
When you're talking to advisors ahead of next year, is there a strategy you're really honing in on that you're communicating that you're like, all right, we like this, we recommend that you do this?
So we have a range of solutions, because the private market range of offerings that we can deliver to our clients is everything from private investment grade all the way through to the more traditional private equity structures. I would say, just to give one example of many that we speak to the advisors and clients about, is, for example, asset-backed finance, an area that the community is looking more and more closely at as a part of their overall portfolio allocation. A really great complement to what others have known for some time in terms of direct origination. And asset-backed finance is about a $20 trillion market out of a $40 trillion credit market, and it provides the ultimate financing to the real economy in the markets that we invest in and serve. And so as we look at the underlying portfolio construct, often investment grade in nature, the inclusion in that portfolio includes aircraft leases or different types of fleet finance, music royalties, et cetera. And the stability of that return profile can be a great addition to an overall portfolio. And we've built that capability now over 15 years by creating operating companies and platforms that have an incremental kind of 4,000 employees to originate on a proprietary basis. And that's real alpha for clients as part of their portfolio. So it's definitely a range of strategies, but that's one example.
Lastly, before I let you go, Stephanie, has there been one thing that has surprised you in markets this year? This has been a wild year. I mean, there's so many big moments.
Who would have imagined a lot of what we saw, right? Especially in the first half of the year. But as I think through certainly how we've navigated it with our clients and in the portfolios, I feel like the transparency of information, the active communication, if anything, it's provided an opportunity to make sure that we're that much more connected to our community of partners around the world. So it's times like this that strengthen relationships.
Yeah, it has been a crazy year indeed. Stephanie Drescher, good to see you. Happy holidays.
Great to see
Thanks
you,
so much for
Brian.
joining us. We appreciate it.
Thanks for having me.
All right, coming up, I'll have more insight from Apollo Global Management on Market Catalyst. Don't go anywhere.